Good morning, everyone. And it's nice to see so many faces here in the room after what seems like quite a spectacular evening. It is my pleasure to be here today and to represent the many great people at Deloitte that have the opportunity to serve the Australian banking industry with all of you each day. I'd also like to acknowledge the traditional owners of the land in which we meet. They are actually the Wurundjeri Woi Wurrung people of the Kulin Nation. That did take me a couple of opportunities to rehearse today. I'd like to pay my respects to their elders, past, present and emerging. One of the things that I enjoy most about my role in the industry is the opportunity to opine on regulatory issues at a thematic level. In fact, this was also the aspect of my role as a regulator at ASIC some time ago that I enjoyed the very most. A lot has changed in the issues that keep leaders of Australia's banking institutions up at night over the last number of years. Perhaps even a handful of years ago, those issues were localised to organisations, to sectors and to industries. Yesterday, we shared discussions on economic resilience, customer resilience, operational resilience, climate resilience, scams, AI and transformation. It's clear that the most important issues for us collectively to solve are bigger than any one of our organisations. They're going to take an ecosystem of organisations, of governments and regulators working alongside by side to solve. It's my very great pleasure to welcome to the stage our keynote speaker this morning, Joe Longo, who will share with us the future focus areas of ASIC. Joe Longo commenced as ASIC Chair on the 1st of June 2021. He has held senior leadership roles over 4 decades in corporate law, financial services, regulation and law enforcement in Australia and some of the world's most important financial markets. He was the General Counsel for Deutsche Bank in London and Hong Kong for 17 years, providing leadership across regulatory issues, governance, corporate law and non-financial risk. Before that, Joe was the National Director of Enforcement at ASIC between 1996 and 2001 and responsible for the coordination and direction of all enforcement and litigation activities. He's also been a senior advisor at Herbert Smith Freehills and earlier a partner at Parker & Parker, now Herbert Smith Freehills. Joe represents ASIC in key national economic and law enforcement forums, including the Council of Financial Regulators, the Australian Criminal Intelligence Commission Board, the Criminal Justice Law Enforcement Forum, and the Serious Financial Crime Task Force. He's also a member of the board of the International Organisation of Securities Commissions, IOSCO, the Asia Pacific Regional Committee of IOSCO, the Trans-Tasman Business Committee, and the EU Asia Pacific Forum. Ladies and gentlemen, please welcome Joe Longo.
Thanks for that very generous introduction, Katharine. I would also like to begin by acknowledging their traditional owners' ongoing connection to and custodianship of the lands on which we meet today, and to pay my respects to elders past, present and future. The financial services industry is too important to the economy of the nation to allow what has happened in the past to continue or to happen again. Do those words sound familiar? They should, as they come from Kenneth Haynes' Royal Commission report in 2019. However, what I want to emphasise is the importance of banking to the financial system and to all Australians in the economy, precisely because of the significant impact banks have on people's lives. Australians rightly have high expectations of them. First and foremost, Australians expect them to work for their customers' best interest, to put them first. Although more than 5 years have passed since the Royal Commission, the lessons it offered should not fade with time. If they do, we know from history that we will be destined to repeat the same issues, and Australian families and Australian business owners have the most to lose. There has been very significant improvement in the culture at banks and financial institutions and the way they treat their customers. We have seen improvements in terms of compliance, conduct and risk governance, and the quality of engagement with ASIC. But as times change and banks respond to new opportunities and risks, bankers need to guard against the re-emergence of problems of the past, whether they be product types, incentive structures, or attitudes towards customers that led to the Royal Commission in the first place. That leads me to the focus of what I'd like to discuss this morning. As of today, ASIC has approved, and the ABA will shortly publish the new February 2025 Banking Code of Practice. And I might just pause there to acknowledge the extraordinary work of Anna Bly and her team. A lot of work went into it. I really want to personally acknowledge that to this audience. You won't find that in the speech, but I really want to take the opportunity this morning to acknowledge that, because the last few days the code's finally been formally approved, and there is a lot of work that goes into it, so thank you. Naturally, there's been debate about this provision and that provision and what the industry is ultimately prepared to commit to. But the code is part of the industry standard for itself to provide good customer outcomes, and its success relies upon what you do every day to assist customers and deliver high-quality banking products and services. My overriding message today is that no matter where the industry is now, it should always be looking to improve and to remember the lessons of the past. Before I get into the new banking code, let's go back to the so what test. Why does this code matter? Codes help to fill the space between the letter of the law and the mission and values statements of each company. In general, effective industry codes achieve this by focusing on three aims. One, they address industry and consumer problems not covered by legislation. Two, they elaborate on what the law requires to deliver additional benefits. And three, they clarify what needs to be done from the perspective of a particular industry, practice, or product. Together, these three things are meant to make a difference in the day-to-day practice of the banking sector. The strength of the banking industry is built essentially on trust and reliability. Having a clear code that lays down customer-centric principles and meets the three aims gives the customer reason to trust, and that's to everyone's benefit. Now, our self-regulatory initiatives, industry codes, have the potential to deliver real benefits to consumers, small businesses and subscribing entities. Since they're industry-initiated, codes also highlight that businesses understand the opportunity they have to enhance services for their customers. However, as we all know, self-regulation is a very small part of the overall regulation of banks. ASIC has responsibility for consumer protection and facilitating and improving the performance of the financial system. By and large, this is achieved through strong laws and considered and appropriate enforcement and engagement. Because a code is industry-owned, the subscribing industry participants need to feel that compliance with the code's commitments is feasible. But having it approved by a regulatory body like ASIC is also beneficial, because it is a signal to consumers that this is a code they can have confidence in. ASIC has used this approval process to defend Australians' expectations for consumer protection. At every stage through the code approval process, we sought to ensure there was no diminishment of key protections of customers, and that the code advanced protections in important areas. So let's look at how that's been achieved. Because of the significance of the banking code to consumer outcomes, ASIC undertook consultation in relation to whether we should approve the revised version of the code prepared by the ABA. During this consultation, stakeholders told us that the draft version of the code had some gaps, and there were elements that had been improved from the existing code that had been removed from the existing code that were of significant concern. We recognise the excellent contributions from consumer advocates, the Banking Code Compliance Committee, AFCA, and others to our consultation. It was clear to us that there were key elements that needed to be protected or enhanced, and that is where ASIC sought and secured improvements. Specifically, ASIC received feedback that the code should retain the diligent and prudent banker obligation for consumer borrowers and their guarantors, continue to include detailed provisions for complaints handling, and third, continue to provide for the Banking Code Compliance Committee's robust oversight and monitoring of subscribing banks' compliance with the code, including a new provision that commits subscribing banks to be bound by their obligations under the Banking Code Compliance Committee Charter. The new code approved by ASIC protects all of these things. It also delivers special key improvements, some of which were proposed by the ABA itself in the draft code in 2023, and some of which were developed through the course of the ASIC approval discussions. And that's an echo of the intense work of Anna's team over the last few months. For example, under the new code, more small businesses will gain access to its protections, consistent with the recommendation of the independent review and the Pottinger review. The aggregate borrowings limit has been increased from $3 million to $5 million, meaning another 10,000 businesses will be eligible. The updated code clarifies how banks will improve inclusivity and accessibility for customers, including via interpreter services, national relay services, and accessible information. This is a great example of putting the customer's needs at the heart of the process. Commitments in relation to the administration of deceased estates have been further clarified, and there are updated guarantor provisions, including a commitment to take reasonable steps to make sure a meeting is held with the guarantor before taking a guarantee. The financial difficulty definition has also been enhanced. That means it includes more examples of financial difficulty causes, casting a wider net to draw in more who need support. So why is this so important? Because the code needs to be responsive to community needs based on the circumstances at the time. For example, cost of living pressures are having a significant impact on many Australians, including through the increased cost of paying a mortgage. Any process that fails to take into account current circumstances fails to put the customer first. The work ASIC has been doing with the ABA and consumer groups on the code also points to the focus ASIC has had on delivering for Australian consumers. ASIC's recent review of financial hardship around home loans has revealed examples where those consumer issues need attention. Stories of people like Amy, a victim of family violence whose request for assistance took 5 weeks and 2 different applications before approval, or people like Sumit, who had to contact his lender 6 times across as many months before his complaint was referred to the hardship team. He'd had held that home loan for 18 years before he started to fall behind. Although we identified some good practices in our financial hardship report, the poor practices we identified included lenders not making it easy for the customer to give a hardship notice, the assessment processes being too difficult for the customer to go through, a lack of effective communication with the customer, vulnerable customers not being well supported, and an insufficient focus on the challenges facing customers. The report, which was published a few weeks ago now, goes into these issues in more detail, but clearly more needs to be done. The distress these issues cause people who are already in distress is one reason compliance with hardship obligations is an enforcement priority for ASIC in 2024. These stories and findings show the impact of not putting the customer at the centre of your business. They also show why enhancing the definitions of vulnerability and financial difficulty in the new code is very much a step in the right direction. As I said at the beginning, no matter where we are, there's always room for improvement, to pay close attention to the expectations of consumers and the community more broadly. While there's much that's good in the code, we need to be alive to apathy, complacency, or in the worst circumstances, backsliding. ASIC will continue to remain focused on the need for enhanced consumer protections, including in relation to proactively identifying customers eligible for basic bank accounts, the proactive identification of consumer vulnerability, and the protections for loan guarantors. Some of these matters that ASIC will continue to progress. Some of these matters that ASIC will continue to progress through reviews and reports to highlight best practice processes. There are a number of areas in which we would like to see further work. For example, we want to see the ABA continue to work with its members on the proactive identification of consumers in higher fee accounts who are eligible for low-cost basic accounts. and ensuring effective processes for migrating those customers into appropriate accounts. On this note, ASIC will soon be publishing a report on its Better Banking for Indigenous Consumers project. This will outline how harms in this area can be addressed. You can expect to hear more in the coming weeks. ASIC will also be publishing a review of credit card offerings, which is a follow-up to our 2 reports in 2018, and a new report on scam detection, prevention and response, which follows our report last year. The code and reports like those I have flagged should be a rallying cry to everyone, a call for banks to continuously look at how they should be putting the customer front and centre. This is particularly important given stories like Sumit's and Amy's that show how Australians have been let down. So, while there are several key improvements in the new code, as you can see, it's not the final word in customer-focused banking. We look forward to following the implementation of the code and seeing its subscribers hold themselves to high standards of implementation and compliance, monitored by the Banking Code Compliance Committee and complemented by the committee's other good work. Discussion about the code is also an opportunity to reorient and remind everyone that we're all here, both regulator, ASIC, and regulated for the customer. Why do I say both regulator and regulated? Because ASIC and its counterparts are ultimately here for the consumer too. It's that focus on the public that is behind ASIC's support for the introduction of the Regulatory Initiatives Grid, or RIG. We think it will better help industry to plan and allocate resources more efficiently. It will also build on the work the Regulatory Developments Timetable ASIC began publishing in 2022 on future activity. While we already have a range of discussions with our fellow regulators, such as our coordination with APRA, the RIG will complement these. When it is released, it will be important to get industry feedback, your feedback, on the content to understand how helpful it is to them, or whether the content is too high level or indeed too detailed. So in conclusion, I want everyone here today to walk out of here with no doubt the emphasis and priority ASIC is putting on consumers. Whether you're a banker, a superannuation advisor, an insurer, or anyone else working in the sectors ASIC regulates, we are here to deliver a fair, strong and efficient financial system for all Australians. And that includes keeping a constant eye to Australians' expectations of the banking code of practice and looking to each one of you to meet those expectations Australians rightly have. As I said at the beginning, banks have a serious impact on the lives of Australians. When the customer is at the heart of their operations, that impact is for the good. When that focus slips, it's for the bad. We should all keep that in mind at the forefront of our minds. Thank you.
Thank you, Joe. We've got time for some questions. We've got a couple of microphones moving around the room. If anyone wants to ask a question of Joe, just throw your hands in the air, get the attention of our microphone wranglers. I'll start while people work up the courage to ask you something, Joe. One of the constant themes of yesterday's discussion and more generally is just the rapid pace of technological change in this space. How much of a challenge is that for you, keeping track of the explosion in multiple different technologies in all the different areas that you guys have to keep an eye on?
Well, it's a challenge at a number of levels. As an agency, and I've sort of spoken about this publicly a few times now, we need to build and invest in the capability to understand these technologies, and secondly, to take advantage of their existence. And that's essentially the story about data. And we can talk about AI, but essentially we need to build capability at ASIC and invest in technologies that will enable us to be data-informed, data-enabled. And I think that's a reasonable expectation of the market, that its regulator will have that capability, and we have to invest. And the longer we wait to make that investment, I think the greater the risk of our effectiveness diminishing over time. So there's an ASIC component to that. Looking externally, I've been really happy with the engagement, certainly with the major banks and others in the sector, sort of engaging with us as to what's going on, and the competitive pressures and the challenges facing the banks. There's a big competitive issue about what these technologies, there are obviously opportunities and risks, and the competition consequences of that. And related to that, I've heard the word resilience used quite a bit already this morning. One of the things ASIC's really focused on, not just with the banks I might add, but is cyber resilience. And so as the years go by, and then we become more and more reliant on a whole range of these technologies, ironically our need for operational resilience and cyber resilience grows. And so that's another big investment. So the only other point I'd make about this area is that there's no question that the banks, and I think business in general, is rightly putting a lot of attention into what the opportunities are for consumers and for increasing the quality of products and services. So it's getting that balance right, wanting to take advantage of these technologies for the benefit of consumers, and on the other hand, we all know, I won't rehearse them right now, but all the potential challenges that AI poses, for example, with scams.
We're drilling down into our cyber resilience a little bit later today in a specialist panel on exactly that. Just throw your hands in the air if you'd like to ask a question, please, of the Commission. We had Brett King as our guest last night at dinner. I don't know how familiar you are with his work, but he was talking about the growth of non-bank or banking adjacent organisations in South America, in Asia, rapidly outgrowing traditional banks, these sort of digital agencies. At the same time, he thought Australia's a sufficiently small country where you might not be able to get a critical mass of 40, 50 million people to sign up to one of these platforms to really get it going. So it was interesting what he thought about the impact of that on Australia. Do you keep an eye on the broader financial sector outside of banks and the sort of challenges coming from other places in the world, different platforms, Alibaba-related financial platforms and the like?
That's a big question. The short answer is yes, but I'd break it down a bit. I think there's an emerging discussion or debate about private and public markets, and I think that's quite profound, where we're raising our capital and what the implications are for governance and risk, and for where we're being able to track what's going on. So the issue for me, one of the issues for me, is in the so-called public markets, we have a lot more transparency. We've got a lot more. We're very used to that. There's more data, and we're just more comfortable in the public markets. But private markets, by definition, aren't as transparent, and that doesn't mean they're bad. But it does mean that if we're relying more and more on private markets, then no one should be surprised if policymakers and regulators like myself are saying, well, what's going on here? So I think that's an emerging issue. The non-bank sector and access to credit and banking, that's been happening for quite a while, and not only in Australia but elsewhere. And I think the technology, the digital solutions have sort of facilitated that. Another area which, in fact, the government's working on right now, and that will involve an even broader jurisdiction for ASIC, is basically payment providers. And that space is primarily regulated by the Reserve Bank, but will have a role with licensing. So I think in all of these areas, the traditional role of banks is going to be affected. And I think the other way I like to think about this is that, what do we expect of banks? So coming out of the global financial crisis, there was a sort of like a utility theory, that banks are an essential service. And so there's a whole discussion around that. But but as the modern economy evolves, the needs of that economy are being met by so many different providers. So as a policy question, our focus is consumers. But then there's a broader economy need as to where capital is going to come from and credit.
Joe, it's Anna Bligh. How are you? But I'd open the batting. Joe, you'd be aware that the Treasurer has recently announced the government's response to a number of competition inquiries, and part of the government's response is a referral to the Council of Financial Regulators for a review of competition impacts on the mid-tier and smaller banking sector. And in that context, I'm just interested in how you and how ASIC think about proportionality when you're setting regulations, enforcing regulations, and how do you think about that issue just as you're going into this review?
We have a very open mind, Anna, going into this review, which was only announced a week or two ago. But having said that, there's a serious underlying question there. So we have the major banks, and then we have a lot of smaller banks, and there's a concern emerging that the regulatory burden falls disproportionately on the smaller institutions, or put differently, that our regulatory settings are more digestible and workable for larger institutions and not so easy for the smaller ones. So there are a lot of prudential issues in there in particular. So from ASIC's perspective, we'll obviously have our say in that work that's only literally just started. Where I think there's some real, some significant questions, and that is the role of competition in financial services and what that actually looks like, what the practical content of that is. And I think this review will sort of shine a light on that. I think this review will also probably have a little bit of a look at whether the access to credit, which I know has been a discussion that's been happening the last 24 hours in particular. I think that review will probably look at that a little bit as well. I haven't got the terms of reference in front of me, but I think the major part of that review is intended to deal with whether the smaller banks, whether that sector is not over-regulated, but whether it's proportionate, to use the words of your question. As far as ASIC's overall approach to regulation, I'd like to think it is measured and proportionate and pragmatic. We're facing, I think, probably the biggest policy scaffolding we've done in many, many years in connection with getting ready for climate reporting. Compulsory disclosure standards seem to be coming imminently, assuming the legislation passes in the Parliament in the next few weeks. There'll be a lot of work there. It's a very broad church, the range of entities that are going to be asked to comply with those standards. So I've sort of spoken publicly about this a little bit, but I think that's a good example of where ASIC will display that proportionality and pragmatism that'll be required to administer those standards.
Try and squeeze in two more audience questions. Take that side and then down there. Yep.
Thanks. Hi, Joe. It's Adam Dandretti from G&T. In an article this year, might have been just over the Christmas period, you were quoted as talking about how you sort of see ASIC's role with its enforcement to sometimes sort of push the boundaries a bit where the law is unclear. And I'm just interested, with sort of all of the discussion we've had at this conference about fraud and scams, and I guess about the report you mentioned you're just putting out, do you actually see ASIC's role with its enforcement in that area and as a particular example of where, ASIC might take that sort of action with its enforcement?
You mean scams in particular?
Yes.
Well, we've published our enforcement priorities for a couple of years now, and so our approach to scams has been very much a collaboration with other parts of government, in particular the ACCC, and we've adopted more of a prevention approach. We have a couple of matters under investigation. I think one that's where charges have already been laid, where we've gone after individuals that are the actual scammers. But this is where law enforcement is a real challenge, because as we all know, a lot of the activity is basically driven by it's industrialised. It's literally organised crime, and very often with state actors behind it, and they're not here. They're not in Australia. But if they're here, and if we can get the evidence, we're certainly looking for opportunities to prosecute people who are behind this activity. In the meantime, we're obviously adopting a range of other sort of strategies. As to our enforcement approach generally and testing, I think the traditional words, regulatory perimeter, I think you'll always hear from us about that. So whether it's reportable situations or DDO I've just mentioned climate risk disclosure or crypto. We've been very clear in our messaging what our concerns are, what our expectations are, and I think providing some guidance to the market as to what we expect. So, for example, with DDO, the design and distribution obligations, the target market determinations, we did a lot of work working with industry and advisors to sort of work through that. That took about a year, 18 months, and now we're running cases. So the idea of regulation by enforcement, which is sometimes people hear about, I don't think that's ASIC's approach. I think if we're going to test the perimeter, we'll let you know in advance. Crypto's a good example where a lot of people think that some people in the market think that that activity is unregulated. It often is. And so you can continue to expect us to deal with that. So I hope that answers your question.
Thank you.
Thanks. Hi, Joe. Jackie Kalman from ANZ. So you've mentioned some of your priorities around scams, resilience, cybersecurity. You've talked about payments. So we know all of those are covered by a range of regulators. So you've got yourselves, APRA, the RBA, and the government's talked a bit about coordination amongst regulators. So just wondering how you think about your coordination between those regulators that cover the range of really high priorities for Australia and how you work together.
No, it's a terrific question. I was just talking to Anna about that over a coffee earlier this morning. It's not going to be easy. I think the regulatory initiatives grid is, to my knowledge, the first real attempt on a whole of government basis to try to coordinate the activities of different regulators. Now, the banking sector in particular sort of feels this. I mean, let's be frank, it's one of the most regulated parts of our economy for good reason, and there's always change going on. When I first started working with Anna, that's one of our early conversations was just how much was going on. So, parliamentary inquiries, hearings, submissions, a whole range of things. So I think there is an opportunity to better coordinate so that the regulatory implementation burden isn't unnecessarily sequenced for no good reason. If there could be better coordination, why wouldn't you do it? There's a public interest in that. But I think it will be challenging. The different agencies have different priorities because of the nature of their mandate. So it'll be very interesting to see how this plays out, I think, the next 6 or 12 months. So I have reasonable expectations of RIG delivering some relief, if that's the right word. To answer the rest of your question, we do a lot of coordination with APRA in particular. I mean, I'm talking to John regularly. We have a range of working groups that meet regularly with the Council of Financial Regulators. So I wouldn't want to underplay the coordination that's going on at the moment. There is a lot of coordination and discussion, but I think we all have to accept we work in a very complex operating environment with this constant law reform, constant issues that we're all grappling with. And so there's a bit of a level of frustration that we're just going to have to live with, I think, because of the complexity of our economy and our regulatory arrangements.
Joe, you've brought it in with single-digit seconds to go. It's like you're landing a 747 in the fog. It's very impressive. Give Joe a big round of applause. Fascinating conversation. Thank you so much, Joe. Wonderful stuff, mate. Thanks.